Okay, let's dive into this. Have you ever actually stopped and wondered how we keep the entire global financial system from just collapsing? Or, how we make sure the massive commercial banks holding all of our money are actually playing by the rules? Well, today we're unpacking the incredibly dense regulatory world of commercial banks. And in this explainer, we're going to do this using a very specific tool, the SASB standards, specifically the Sustainability Accounting Standards for Commercial Banks. These standards give us a genuinely fascinating window into how regulators try to measure things that seem totally unmeasurable, like business ethics and systemic risk.
Here is our roadmap for today. We'll cover trust in the banking system, regulating business ethics, the whistleblower safety net, the threat of systemic risk, and finally, surviving economic shocks.
Section 1. Trust in the banking system. So commercial banks don't just hold on to our cash, right? They accept deposits, they make loans to individuals and massive corporations, and they finance major infrastructure. By providing these services, they serve an absolutely essential role in the functioning of global economies. And because of this, trust and stability aren't just, nice-to-haves. They are absolutely paramount concerns for the entire industry. But that brings up a really difficult question. How do we actually measure a bank's trustworthiness? Trust is a totally abstract concept. You can't just put it on a scale. But regulators and investors need hard, cold data. And that is exactly what the SASB standard does. Following an inside-out diagnostic arc today, we're going to see how this standard takes the abstract concept of trust and puts a literal, measurable price tag on it by tracking specific performance metrics and behaviors.
And this brilliantly illustrates the two main pillars of banking compliance we'll be exploring. Over on the left side, we have internal conduct. This is all about business ethics, preventing fraud, and ensuring the people inside the bank are strictly following the law. Then, on the right side, we have external impact. This is systematic risk management, how a single bank's operations, its overall complexity, and its interconnectedness impact the rest of the world.
Section 2. Regulating business ethics.
The regulatory environment surrounding commercial banks is constantly evolving on an international level. To even operate, these entities must adhere to a highly complex, incredibly strict, and sometimes inconsistent set of international rules relating to their performance and conduct. Just look at this list. This is just a quick snapshot of the vast web of rules banks have to navigate. They are subject to strict legal requirements against tax evasion, money laundering, and corrupt practices. They have to provide exhaustive disclosures on issues like fraud, insider trading, antitrust behavior, price fixing, market manipulation, and malpractice. Honestly, the sheer dizzying mountain of compliance paperwork banks have to file just to prove they aren't engaging in market manipulation probably uses up half the ink on the planet. But it's a massive and absolutely necessary burden to ensure that banks are operating fairly and legally.
Looking at the accounting standards, there's a specific metric to highlight here, FNCB 51A.1. This metric requires banks to publicly disclose the total amount of monetary losses as a result of legal proceedings associated with all those infractions we literally just listed. So we are talking about the hard numbers: fines, civil judgments, penalties, disgorgement, and restitution.
What this metric really does is act as a data-driven behavioral mirror. It forces banks to put a literal price tag on bad behavior. It translates those abstract ethical failures into concrete financial penalties. If a bank has weak internal controls, well, they're going to face legal proceedings, and those monetary losses will be clearly documented right there for investors and regulators to see. It proves that ensuring regulatory compliance isn't just about doing the right thing. It is absolutely crucial for minimizing losses and protecting shareholder value.
Section 3. The whistleblower safety net.
So how do banks catch these ethical failures before they snowball into massive legal judgments? Well, in many jurisdictions today, regulators are offering enhanced financial rewards for whistleblowers, and that is directly increasing the number of complaints being brought forward. Because of this, the SASB standard includes metric FN-CB-5108.2, which requires banks to thoroughly describe their whistleblower policies and procedures. This means detailing their internal compliance programs, whether they use independent third-party hotlines, exactly how they publish those hotline numbers, the incentives they offer for reporting violations, and the actual methods for submitting tips. A really robust safety net like this minimizes legal losses because it allows the bank to identify and correct corrupt practices internally, long before they turn into a systemic, highly public legal disaster.
Section 4. The threat of systemic risk.
Now, what's really interesting about this next concept is what happens when we shift our perspective and zoom out. We've looked at what happens when individuals inside a bank fail, but what happens when the entire bank fails? Because of the sheer interconnectedness of the global financial system, a single bank failure can contribute to massive market disruption and full-blown financial crises. And this brings us to a highly critical piece of regulatory jargon, the GSIB, or Global Systemically Important Bank. Think of the global economy as a room completely full of dominoes. A GSIB is one of the giant, heavy dominoes right in the center of the room. Its massive size and complex interconnectedness mean that if it falls over, it's not just a problem for that one bank, it triggers a wider financial crisis that knocks over everything else.
Because these giant dominoes are so incredibly critical, regulators measure exactly how dangerous their failure would be using a GSIB score. This score is calculated using a highly specific methodology established by the Bank of International Settlements Basel Committee. Basically, banks are scored across 5 categories: size, cross-jurisdictional activity, which is essentially their global footprint; interconnectedness; substitutability, meaning how hard would it actually be to replace their services if they just vanished; and complexity. Banks have to publicly report this score in basis points, so absolutely everyone knows exactly how much systemic risk they pose.
So why does this matter to you? What should you actually take away from this? It matters because a bank's failure is literally never isolated. When a commercial bank fails to manage its risks effectively, its liabilities increase and huge market disruption follows. In our highly interconnected global economy, one falling GSIB domino directly impacts your personal savings, small businesses in your town, and global stability as a whole. This systemic interconnectedness has rightly become a central concern for regulators globally.
Section 5. Surviving Economic Shocks. Okay, so if regulators know these giant dominoes exist, and they know their failure would be catastrophic, how do they make sure those dominoes are sturdy enough to withstand intense economic pressure? Well, I want you to imagine a severe economic crisis, a massive market downturn. What happens? To prepare for this, many jurisdictions require that banks undergo supervised stress tests. Think of these as extreme financial fire drills. During these tests, a bank has to mathematically prove that it has sufficient capital reserves and liquidity to absorb massive losses, continue its operations, and meet its obligations, even under the absolute most adverse economic and financial conditions.
Let's move forward and see how this builds into a real-world strategy. Under metric FNCB 550A.2, it's just not enough for a bank to take a stress test and quietly put the results in a drawer. They actually must describe their approach to integrating those results into their daily operations. How do the results of mandatory and voluntary stress tests inform their capital adequacy planning? How does it actively change their long-term corporate strategy? And how does it inform their environmental, social, and governance, or ESG strategy? The data has to drive actual, tangible business decisions.
So we've seen how these standards put a price tag on ethics, how whistleblower hotlines provide a much-needed safety net, and how stress tests try to reinforce the biggest banks in the world. But as we wrap up, I want to leave you with this provocative thought. Is transparency actually enough to stop the next global financial crisis? These accounting standards provide incredible visibility into a bank's operations, for sure. But data alone doesn't prevent bad decisions, it just illuminates them. Ultimately, it's up to regulators, investors, and honestly all of us to hold these institutions accountable based on the numbers they report.